Good morning. It's Thursday, the 21st of November, and this is Govindraj Ethiraj, headquartered and broadcasting as well as streaming from Mumbai, India's financial capital. The take. I've been approached by several insurance agents, life insurance that is, over the years, and almost on all occasions I found it tough to buy a pure term cover, which is a stripped down pure insurance cover that provides for the family on my death. I'm not alone, as I find several people wary of life insurance unless there's something tied to it or packaged with it, like a home loan cover, which is that you've taken a home loan, but in the case of your untimely demise, the insurance will take care of the rest of the loan. There are other products like the very popular unit-linked insurance plan or ULIP, which are linked to stock markets and thus offer capital market appreciation, which is done better, but insurance itself remains a problem. And this also applies to general insurance, distinct as a product, but also displaying many similarities from a consumer or usage point of view. Not surprisingly, a new McKinsey study says that the industry's penetration rate has slipped from about 4.2% in 2022 to 4% in 2023, indicating that progress has not been at par with India's economic growth. On the other hand, while insurance achieved a robust compounded annual growth rate of over 17% in new business premium, the top 5 private life insurance companies in India have experienced what it calls tepid net profit growth of under 2% compounded annual growth rate or CAGR over the last 5 years. So one reason for this is costs are rising faster than incomes, which is also unlike other segments in the financial services industry, including banking and asset management. Moreover, the report says that the growth in premiums for general insurers has been predominantly driven by increased hiring, with little to no improvement in productivity amongst top players. So on the other hand, the report says, and this is interesting, that the government could potentially save about $10 billion annually by expanding insurance penetration to encompass underserved populations and events. McKinsey says comprehensive life insurance coverage could assist the government in alleviating the burden of providing ex-gratia benefits to families affected by the loss of life or livelihood due to accidents and unforeseen events. Remember, when accidents happen, it's usually the government that is handing out ex-gratia payments. But if they were suitable or suitably structured insurance covering it, then I guess that could not happen, or insurance would take care of it. Targeted intervention programs for crop insurance could also contribute to minimizing crop losses, reducing loan defaults, and improving yield. Similarly, creation of more natural disaster insurance pools with mandatory coverage for ecologically sensitive areas could minimize financial losses for small and medium enterprises caused by catastrophic events. And that's something we've been talking about in different contexts, including that of climate resilience and disaster resilience. Some of these are not new arguments in themselves, but more, I would think, are interesting reminders. It's also interesting that what we think about as insurance and do not. McKinsey says some 70% of consumers spend about 25,000 rupees annually on purchasing and repairing appliances, yet only 40% have any form of insurance coverage. On the other hand, Peeyush Dalmia, one of the authors of the report, tells me that insurance is better communicated and thus sold while we are at retail stores. The example I could think of is like going to a Chroma and buying a refrigerator or even a smartphone and then buying insurance along with it for that product. Similarly with homes, there's so much to insure in homes which we may not or do not. So maybe one lesson from this is the fact that there is diminishing person-to-person contact in selling a product, and this is something that takes more convincing and explanation, and which is why perhaps insurance is not moving as much as it should or could. Now, insurance was never an easy sell, but that only underscores its importance. Selling it profitably without promising the earth and the moon is also equally important because that ensures the sustainability of those businesses, but that's equally important as the lives or homes that insurance covers. And that brings us to the top stories and themes for the day. The stock markets wait now for election cues in the absence of others. Rating agency ICRA projects lower growth for 24-25. India needs insurance, but Indians are not buying as much. Why is that? Is there a global crude oil glut coming?
This is a core report with Govindraj Ethiraj.
Markets now bank on election cues. Wednesday was a markets holiday because of voting in the state of Maharashtra for local elections. That includes Mumbai City. And yes, I did go out and vote on Wednesday morning, as did my producer of this show. Meanwhile, the markets on Tuesday were up after a while, with the Sensex closing up 239 points at 77,578 and the Nifty closing up 64 points at 23,518. That, I repeat, was on Tuesday. All in all, the markets are steady for now, waiting presumably for the Maharashtra election results, which have some political ramifications, but little or no economic ramifications, except that states like Maharashtra have stretched out further in terms of voter-friendly schemes which could affect their balance sheets, which has, of course, other downstream challenges. Meanwhile, more on the September quarter earnings, tepid earnings growth in the September 24 quarter, that's the second quarter, is not restricted to India, according to analysts at Nomura, quoted by Business Standard, who suggest that this has been the case with most of Asia, excepting Japan, in the quarter gone by. The September quarter earnings season hasn't been up to scratch, with more misses than beats at the Asia ex-Japan level, says Nomura. Though on a weighted basis, they say the result season is not that bad, contrary to what is suggested by a simple beat to miss ratio. And large cap index stocks, particularly in MSCI China, have had a good earnings season so far, according to the Nomura report. On the Indian context, they say that of the 87 Indian companies under Nomura's coverage that are also part of the MSCI indices and have at least 3 analyst estimates, September quarter results for 48 companies have missed forecast or estimates, while 29 have beat earnings estimates and 10 reported inline numbers. So it's not that bad if you look at it. So the problem clearly is not so much with the performance, which could be correcting cyclically, but maybe the expectation of very high non-stop growth. Trump tariffs will hurt economic growth. Donald Trump's proposed tariffs will dent U.S. economic growth going into 2026, according to Morgan Stanley's chief global economist Seth Carpenter, quoted in CNBC. Trump has spoken of, as we've been talking about, a blanket tariff of 10 to 20% on all imports, along with extra tariffs ranging from 60 to 100% on goods imported from China, as a means to extract funds from competing countries. There is also a question of when and how swiftly these tariffs get implemented. In the event that they're all enacted at once, they could result in a big negative shock to the economy, Carpenter told CNBC. Carpenter, who maintained Morgan Stanley's base case of these tariffs being spread over 2025, said that they would lead to higher inflation. Then on to 2026, we think growth starts to come down as a great deal in the United States. Then into 2026, we think growth starts to come down a great deal in the US because of those tariffs and some of the other policies, he cautioned. He said that it's very clear that tariffs push up inflation, and it's very clear that tariffs are a drag on growth for the United States and for the countries that the tariffs are put on. Brokerage firm Siebert noted that if those tariffs are levied, especially on top of those already imposed by the Joe Biden administration, many sectors like automobiles, consumer electronics, machinery, construction, and retail would see higher inflation. For example, the 60% tariff on Chinese goods, along with Biden's existing 100% tariffs on Chinese-made electric vehicles, could significantly impact the auto industry, while a universal 10% tariff on consumer electronics imports would increase costs for companies such as Tesla, Microsoft, and Apple. The higher costs will obviously or likely be passed on to consumers. Slower GDP growth projections for the current year. Rating agency ICRA on Wednesday said India's real GDP growth for the September quarter is likely to decline to 6.5% thanks to heavy rains and weaker corporate performance. ICRA has, however, maintained its full-year growth estimate at 7% on expectations of a pickup in economic activity in the second half of the fiscal. The Reserve Bank is, meanwhile, holding on to its estimate of 7.2%. Official data is expected to come out on November 30th, and the first quarter, by the way, the GDP growth was at 6.7%. ICRA has said that the dip would be due to factors like heavy rains and weak corporate margins, but also says that there is headroom for Government of India spending more, and it could expand by 52% year on year to meet the budget estimate for the full year. A question that comes to my mind and has been coming in the last few weeks is, what is the normalization level for economic growth, assuming that there was a slowdown because of elections and heat waves or essentially externally limiting factors? So I put this question to ICRA chief economist Aditi Nayar, and I began by asking her how she was computing the latest figures and the impact of external factors like heavy rains in the last quarter.
Weather conditions is certainly one factor that has been a bit of a seesaw as far as the economic growth is concerned. And the other one is the elections that we had in the first quarter. So Q1, we saw a heat wave that had an impact on a lot of, particularly retail related sectors. And we had capital expenditure of the government, both the center and the states, contracting amidst the parliamentary elections. In Q2, we had at least the capex part turning around. We had a high expansion from both the center and the states as far as capital expenditure is concerned, which is expected to be a good driver of growth in this quarter. And we had a abundant rainfall. The monsoon didn't kick off too well, but then it ended up being quite plentiful by the time the season ended. And the Kharif output is projected to be quite good for a number of crops. These were the tailwinds. The headwinds really in this quarter were that the heavy rainfall actually doused activity in sectors like mining, electricity, freight. Exports didn't do well, especially on the merchandise side. For the year as a whole, our expectation is that actually the benefits of the monsoon will really be felt in the second half of the year. So, rural demand should be much better once the farm cash flows from the Kharif season come in. The headroom for growth on the capital expenditure side is like as high as 52% for the center. And these two are expected to really push up growth in the second half of the year.
So I'll come to the headroom part, but I'm just trying to understand, so we are in November now and heading to the end of the calendar year. Was this year so different from previous years? I mean, I know that there was an impact of rains and elections and so on, is what I'm trying to understand, because a lot of people ask me this, saying that how different was 2024 calendar at least, that it can throw so many calculations off the track.
See, in terms of the election impact, this was very similar to what we see every 5 years when the parliamentary elections happen. So, we in fact did expect that there was going to be a slowdown in Q1 and that was going to be transient and that would turn around after that. And we're already seeing that underway. What ended up being a big dampener, literally speaking, was the heavy rainfall that we got in Q2 because that really had an impact on mining. And if you don't get coal out of the ground, you also don't end up shipping it across the country. And electricity demand was feeble, to say the least, from the household sector. And the agricultural requirement for groundwater usage was also quite low. So these are, however, fairly transient factors. So they should turn around after that.
Yeah, so you're saying that we have other years as well where we have rains, maybe not as high intensity as this year, and though we've seen high intensity rains in previous years as well. I'm just trying to understand, Aditi, where is it normalizing, and is it normalizing at all, or was it so far at least, was it such a dramatically different year?
See, when we look at our own potential GDP growth estimates, we think that India's potential GDP growth over the medium term is 6.5 to 7%. So if you're going to end up with a 6.5 to 6.7% kind of growth in H1, that's not terrible. It's within the range, right? And even for the second half of the year, on the GVA side, we're looking at the estimates coming up to about 7% because of our estimates for how indirect taxes and subsidies will move. Our GDP forecasts for Q3 and Q4 are ending the year at 7.4% for Q4. Average, we're looking at 7% for the full year. And again, that's at the top end of our potential GDP growth calculations. It's not such an abnormal year at all from that point of view.
Isn't there a contradiction then in some ways?
But this happens, right? We have base effects, we have transient impact when you have elections that prevent spending. Not prevent is a very strong word, but which, lead to a slowdown in spending while the model code of conduct is on. And you allow for faster spending after that, which is what has happened with the government notifying that, the typical kind of monthly expenditure guidelines have been relaxed a little bit because there is this huge headroom to spend and we want to spend, we want to be able to support GDP growth. So that is something that is going to be a little bit like an offsetting factor, which is going to push up growth in the second half.
Got it. So the other point which you mentioned is that you're also looking at a slowdown in personal loan growth on private consumption. So how is that now stacking up in this whole thing?
So consumption is an interesting story. Last year, our view was that urban consumption was quite strong, although it was uneven, and rural consumption and sentiment was not very optimistic because of last year's bad monsoon. And so there's a little bit of a turnaround that we're seeing. Rural consumption, we expect, will be much better in the second half of this year. And also the fact that reservoir levels are quite high in most of the states is giving a little bit of an insurance to farmers going ahead that at least you're not so dependent on the timeliness of the winter rainfall and the next monsoon. So that's quite a positive factor going forward. However, we do have concerns on the fertilizer inventory. I mean, that's something that we're watching out for. On the other hand, urban consumption, we've been bucketing it into three cohorts. So the high income, high net worth, where consumption continues to be very strong. The second positive cohort has been the new entrants into the workforce, particularly into the formal workforce, where family incomes can suddenly change and their spending behavior can suddenly change when you have a person that's getting a formal sector job in a low income family. And the third bucket, which is where the stress has been, is what we call middle income, middle age, where high inflation has a much bigger impact on spending decisions. Now, inflation has continued to be quite high. We've seen two rounds of the readings on the urban consumption survey from the RBI, which dipped. So the May and the July rounds indicated a dip in the urban consumer confidence levels. It turned around in September, but it's still below the peak. And then, of course, we have this factor of personal loan growth, which is expected to slow down. And all of this put together suggests that urban consumption may not be as strong as what it was last year. And it may, in aggregate, slow down a little bit. However, within that, of course, high income, high net worth, we do expect is going to remain a very strong bucket of consumption.
The personal consumption, therefore, has nothing to do or has little to do with all these other external factors like weather and elections and so on.
Well, they certainly could for some cohorts. So, for instance, people who work in the retail sector, their weather has an impact. If you're in North India, we suffered a heat wave, so we didn't go out very much. We had heavy rainfall, we didn't go out very much, and now it's very polluted. So, again, we're not going out very much. So, all of this has an impact on your retail footfalls, restaurants, anything which is out of the house, service consumption, which is not a necessity but discretionary spending, is going to get impacted. So people in the retail sector could definitely see, people like who work in restaurants or beauty salons, people who work on tips in addition to their monthly income. Certainly for people like that, weather could be a negative factor on all of these disruptions that we've talked about, could definitely be a negative factor.
Right, Aditi, thank you so much for joining me. The crude oil glut. There is an interesting free market scenario that will soon play out, in this case oil, but potentially elsewhere too. So Donald Trump has promised that there will be more drilling for oil in a political message against the environmentalists, but the fact is that the US is drilling already like never before. And more drilling, quite obviously, will create a glut and potentially bring prices down. President-elect Donald Trump's vows to frack are about to collide with a global crude glut that's set to finally temper record shale production, Bloomberg reported. Donald Trump has apparently said he'll push America's shale companies to ramp up output, telling supporters to pump prices would fall even if it meant producers drill themselves out of business. But as Bloomberg points out, his second term follows 2 straight years of record US output, which has also made America the largest crude oil producer in the world right now. So far, the independent oil producers responsible for most of the shale boom over the past decade have no plans to radically alter their drilling after the election, which is not surprising. Diamondback Energy, Devon Energy Group have indicated growth rates of 2% or less in 2025, says Bloomberg, while EOG Resources and Occidental Petroleum are expected to keep activity flat. And Occidental's CEO has even warned of declining growth rates in the United States over the medium term. Investment bank Macquarie, which correctly predicted last year's stunning growth, says output reaching about 13.9 or close to 14 million barrels a day by the end of the year, 5% above current Department of Energy estimates. But there is oil being drilled elsewhere too. Bloomberg says the growth in the United States, combined with new barrels from Guyana, Brazil, and Canada, have set the stage for a massive crude glut in 2025, with the International Energy Agency warning of a 1 million barrel a day global supply surplus. Macquarie sees supply outpacing demand by 2.4 million barrels a day in the first quarter when Trump will be sworn in, and traders are already pricing in a surplus, with West Texas Intermediate crude retreating by more than 3% this year. Under Biden, the US solidified its position as the world's top oil producer and is now pumping 50% more barrels each day than Saudi Arabia, says Bloomberg, adding, by the way, that there are other forces of capitalism at work. A $290 billion wave of mergers and acquisitions in the past 2 years has meant that many of the independent producers that were driving production growth during Trump's first time in office were bought or merged into larger entities that reined in capital spending and boosted shareholder returns. Ultimately, though, oil prices could be the biggest obstacle to US growth, according to a vice president at S&P Global Commodity Insights. According to him, at $70 a barrel, shale independents can both grow and generate free cash flow. But at $60 a barrel, they have to make a choice, and we believe they'll choose choice for the shareholders. And finally, to sum it all up, Brent crude is presently quoting under $74 a barrel. That's going into Wednesday. So no real change in the last few days. Insurance is slowing down. A new McKinsey study, which we just discussed a little while ago, says that the industry's penetration rate has slipped from 4.2% in 2022 to 4% in 2023, indicating that progress has not been at par with India's economic growth. On the other hand, while insurance did achieve a robust compounded annual growth rate of over 17% in new business premium, the top 5 private life insurance companies in India have experienced tepid net profit growth of under 2% compounded annual growth rate in the last 5 years. Now, there is a reason for this, and do hold on for all of this. One reason is costs are rising faster than incomes. This is for the insurance companies, which is also unlike other segments of the financial services industry, including banking and asset management. So productivity is lower. On the other hand, the interesting insight is that the government could potentially save about $10 billion annually by expanding insurance penetration to encompass underserved populations and events. I reached out to McKinsey partner and report author Peeyush Dalmia, and I began by asking him why the insurance market in India was not growing as much as we could or should expect.
Govind, thank you for having me, first of all. Think about the Indian insurance market. I think one thing that is common, and it's common across India, I guess, for every category, that there is growth everywhere. Every single category that we can think about, whether it's life insurance more broadly, within general insurance, of course, you have multiple categories. All those categories are growing roughly anywhere between 12 to 15% is a growth if you take the last 5 to 10 years across all categories. Having said that, I think the other thing which is common across both the life as well as the general insurance industry is that the productivity has not grown. I think both sets of industries have seen cost actually grow faster than premium. Potentially, this is one of the few industries where the top 5 players, and I'm not even talking about the industry more broadly, but the at scale top 5 players have seen cost grow faster than premium, which effectively means that the productivity gain has not been there. The industry has not found operating leverage yet. So growth, absolutely yes. Operating leverage at this stage, we don't see over the last 4 or 5 years.
So, from a consumer behavior point of view, is that because people are not willing to pay more than a certain amount, or there are not that kind of flexible schemes offered, again, on life as well as general?
I think it's a great question that you ask. I think on the life side, in fact, when you disaggregate the growth, all the growth has come because of ticket size increase. Actually, the volumes have been constant. So we've seen the 10, 12% growth. It's predominantly been driven by ticket size as such. In fact, the number of policies in force have been flat to marginally declining. And the number of policies sold in a year, if you look at the last 4 to 5 years, again has been flat as well. So the consumer willingness to pay, the ticket size increase suggests that the same set of consumers are willing to pay, but we've not been able to drive penetration, predominantly because distribution has not sort of really innovated itself across both the life and the general insurance industry today. The other point, we've also not seen innovation from a product perspective, partly driven by, I think, regulation, but partly driven by, I think, the manufacturers themselves actually not sort of thinking out of the box. Just as an example, and this is more from a regulatory perspective, India does not allow value-added services for insurance companies. And that again sort of restricts what an insurance company is able to do from a product innovation perspective.
What's a value-added service in this context?
A value-added service is, something that you can offer beyond the core insurance product itself. Just to take a simple example, if I go and basically sort of insure your home, today where the penetration is incredibly small, the home has a whole set of appliances, within that as well. Can I sort of, pitch you that I'm going to take care of repairs and services for those appliances as well, beyond offering the core insurance itself? And that just makes a product more exhaustive and appealing from a consumer perspective, vis-a-vis just talking about a plain insurance product as I go and have a conversation with the consumer. Several countries do allow value-added services for insurance companies to be able to offer.
And staying on life, you talked about the plateauing or the flattening of the market in volume terms and the growth only coming in through ticket size. How is that, or how does that compare with other markets, whether it's the Western markets or other markets in Asia?
Most emerging markets see a volume growth as well, because the penetration basically sort of, goes up as you sort of, evolve. The Western markets, of course, basically end up seeing more price growth and less volume growth. Anyways, I think for them, the overall growth rates are low single digit, and half of it is driven by volume, half driven by price. Across all industries, the growth is double digit. What's surprising is that all of that, particularly the life insurance industry, comes from ticket size today.
Then let me ask you the question which I maybe should have asked earlier, which is what's the penetration like in India in life first when you compare with these markets?
There's a simple answer and there's a complex answer to that. I think the simple answer is that on life in particular, the penetration is equal to developed markets and much higher than sort of most Western markets. And the penetration, though, has come down a bit over the last 4 to 5 years, predominantly because the number of policies have remained exactly the same. Having said that, I think the more complicated answer is that when you unpeel the onion, a lot of the penetration is driven by savings and investment products, even in life insurance. If you look at the core protection, I think that's a very small percentage of Indian life insurance industry today. The metric that we typically use sum assured to GDP, which basically says how much actually is the money that is going towards protection. And that proportion in India today is roughly about 1/8 to 1/10 of what you see in other markets, the developed markets.
You've also said in your report that if the government expands coverage of insurance, that will also bring down its own cost of paying out ex-gratia and so on in, I guess, when accidents happen and things like that. Can you elaborate on that and how you came to that figure?
See, I think we looked at all events where the government basically sort of ends up paying a certain quantum of money, ends up sort of expending a certain quantum of money, either to rebuild property or to take care of lives, etc. And those events clearly are only increasing, I think, as we move forward. I think the insurance penetration in that context, and we said even if we get to an average of where emerging markets are across different product categories, say home, for example, if you get to a 30-40% penetration on home insurance, what is the quantum of money that will be saved for the government in the event of a catastrophic event? And that number comes out to be about $10 billion annually.
Just to switch to general for a moment now, one interesting thing I saw in your report was appliances. I'm guessing that people are also more aware, but when you buy online or even if you go today, at least in metros, you go to a store like a Chroma and then people bundle everything and sell it to you. So is that what is growing the market? And also, therefore, is there greater potential than perhaps there was in the past?
There is significant potential there. I think whether that is growing the market, I think it's a very small portion of the market today. And hence, that's not necessarily the big driver for growth. But again, that we use that as an example to illustrate the nature of service offering that can be made available and that can be useful from a consumer perspective. To your question, by the way, I think surprisingly, when people buy online, the attachment rates of insurance is almost close to about 1/10 of when they buy offline, because insurance still continues to be a product that is sold and not bought. Even the most aware customer actually does not buy the extended warranty or the insurance coverage associated with the product, even for very expensive products as such. But when they go buy offline, the sales representative actually explains to them or sells them the product, and that's when they buy. So there is a significant room for awareness in the Indian market across several categories. And even the most aware, digitally savvy customer today does not end up buying insurance by himself or herself.
Right. Peeyush, last question. So when you look at the insurance landscape in this country, and that includes health and hospitalization and so on as well, where do you feel the major effort needs to go in? Is it on, for example, innovation by companies? Is it regulation? Is it more consumer awareness, which is self-awareness, or something else?
It has to be a combination of all. I'll give you an example of the mutual fund industry, which I think has done incredibly well in the mutual fund Sahi campaign, which has created awareness more broadly amongst the consumers. There is potentially, something similar that can be done for the insurance industry as well. The mutual fund industry sets aside a certain percentage of profits every year. My understanding is about 1% odd that goes into that consumer awareness. I think the regulation and the innovation by the companies go hand in hand. I think it has to sort of happen together along with the consumer awareness for the penetration to increase.
Right. Thank you so much for joining me.
Thank you, Govind. Thank you. Pleasure.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.